Welcome to the podcast. Before we begin today's analysis, please note that the information provided in this episode is strictly for informational and educational purposes and does not constitute financial or investment advice. You should always conduct your own research and evaluate your options based on your individual financial situation and future expectations. Let's start with Apple. Revenue rose by 16%, primarily because the company is not making massive investments in artificial intelligence, keeping capital expenditure low. However, when market sentiment shifts, Apple could face downside pressure for being penalized over its lack of heavy AI spending. Earnings per share reached 2.02, but the gross margin contracted from 50.1 to 47.9 due to tariffs. Shrinking margins are a significant red flag for investors, as it indicates the company is sacrificing profitability to drive sales. iPhone sales grew by 22%, and Mac revenue reached $10.35 billion, though both iPad and services came in below expectations. Capital expenditure stood at just $3.4 billion, which is minimal compared to high spenders like Amazon at $54 billion. The stock dropped 9% following the result, pressured by the lower margins and a PE ratio sitting at 36. Comparing a PE of 36 with 20% growth against competitors with PE ratios between 18 and 25, delivering triple-digit net income growth, highlights the valuation disparity. Right now, there is little incentive to touch Apple, and staying away is the prudent path. Looking at Sanofi, the figures in the pharmaceutical segment do not represent a great deal. The stock trades at a high PE ratio of 77. Although revenue is rising, EBITDA is not keeping pace, and net income plummeted from $4 billion to $334 million in a single quarter. The primary attraction remains its strong dividend. While sales managed to beat expectations, investors are increasingly concerned about the drug pipeline. Anyone considering Sanofi should evaluate it strictly as a dividend play rather than a growth opportunity. From a technical perspective, the chart looks bearish, and investors must be mindful of the risk of dead money, where capital remains locked in a stock that fails to move for years. Turning to other opportunities in the market, Micron was attractive around $710 and is now rebounded to $800. Looking ahead to November, strong entry opportunities exist across large-cap stocks like Google and Microsoft. For ETF investors, a practical strategy is to execute a small initial purchase and maintain a consistent dollar-cost averaging approach over time. Finally, examining Amazon, total net sales surged 20%, beating analyst expectations of $196 billion to land at $200.6 billion. Earnings per share rose significantly to 5.75, far exceeding predictions of 1.82. Net income hit $62.6 billion, marking a massive 243% increase compared to last year. Historically, Amazon's PE ratio hovered around 33 to 35, and buying at 34 was justified by anticipating that earnings per share would eventually drive net profit growth into triple digits. Management had repeatedly indicated that key business segments would begin delivering substantial returns in 2024 and 2025, and those results are now clearly visible. Operating income rose by 43%, AWS cloud revenue generated $42.2 billion, and advertising increased by 26%. Regional sales grew 16% in North America and 15% internationally. Capital expenditure reached $54.2 billion, representing a 69% increase over last year. This heavy investment in AI infrastructure and data centers pulled free cash flow down to $7.6 billion, compared to $18.2 billion last year. For the third quarter, management provided standard guidance between $197 and $202 billion, as Prime Day was moved to June instead of its traditional July window. Amazon's massive spending is showing concrete returns and generating cash flow, with AWS sustaining growth over 5 years accelerated by AI, and the custom chips business reaching a $25 billion annual run rate. Similar to the momentum seen with Microsoft, seeing solid revenue growth offset initial capex fears and satisfied investors, rewarding the stock with a 14% gain. Following such a substantial price surge, the smartest strategy is to wait for the stock to pull back rather than adding positions at elevated levels. Make sure to follow our page right now to stay updated and receive all of our latest market insights as soon as they drop.